Yes, thank you. To be honest, it's the first time in ages that I'm using such a microphone. Yeah, so people who are more like my generation, you probably still know Dieter Thomas Heck. Ja, guten Abend, meine Damen und Herren. So it feels a little bit like the 80s have come back. So I'm very pleased to be here for the third time. I'm very much looking forward to my third mug with the Blockchain Conference. My name is Philipp Maum. I'm here from around the corner from Technical University of Munich, where I happen to do quite a lot of work revolving around, well, crypto and law. And last year, I talked a little bit about the regulation and the issues around stablecoins. And as you all know, stablecoins are the talk of the town right now. And I thought, well, this year it could be a good idea to go one step further and speak about something that I think is, as a concept, very, very interesting, but surprisingly few people actually know about it. And that is actually, obviously, the idea of commercial bank money tokens. The background, and this is not a daring hypothesis, is, you all know that, we are seeing right now a bit of a competition between different concepts or approaches when it comes to the future of payments. I mean, future of payments is always such a big word, but it is happening right now. And I think in 2 or 3 years we will know. I'm not saying that we'll have a new payment system, but I think in 2 or 3 years we'll know in which direction the whole system will be moving. So it's actually interesting times to be in the industry or at academia. This starting point is not so surprising. The established banking system is, let's call it what it is quite shitty. And we all know why. The banks have their, do we have a point here? Have their segregated internal systems that are usually not compatible with each other. The banking system, as in transfers, and I've spent 3.5 years in Australia, and each international bank transfer was $40, which is 25 euros. It's expensive, it's relatively slow, it's relatively difficult to use. Let's talk about IBANs, etc., etc. So it is something that kind of works, but it's not good. And it has been since Bitcoin saw the light of day. There has been the talk of the town that DLT and blockchain will at some point replace the banking system as we know it. But the banking system is still around. I'm not talking about the banking system itself, that will always be around, but about the payment system run by the bank. So if we think about the banking system as it is in terms of pop culture, the banking system is a little bit like Don Corleone. The Godfather, everybody knows that what he's doing is maybe not ideal. No one really likes him, but come on, he's kind of reliable. And for any one of you who's watched The Godfather, we all know what happened as soon as he passed away. And the banks are kind of similar. They are here, but personally, and that's more like personal opinion now, I'm not looking forward to the banks to disappear. So the first contender is Don Corleone. Talking about payment systems, and we could also use stuff like PayPal or whatsoever here, it's the same deal. Credit cards, from my opinion, are even worse. Yeah? Payment systems are extremely high. It's kind of limited use, basically the use cases that you have. Of course, it's also the internal system of the banks and the general network of the US payment providers. And as we all know, the problem about US reliance has become kind of bigger over the last 1.5 years. So I just put in credit cards here just to be thorough. But if we think about pop culture, for me, credit cards are a little bit like Dagobert Duck, yeah, who sits in his vault full with gold coins, etc., etc. Next one, and this is something which some people might disagree with, fair. Bitcoin will not make it. Bitcoin will not make it for various reasons. I know there's a little bit of a discussion to what extent Bitcoin or derived systems like Bitcoin Lightning, etc., are from a technical perspective even capable of really being a thorough worldwide global banking transfer system. Let's not talk about that, but what we know is Bitcoin has a bit of a dubious reputation and has earned that quite well over the last 10 to 15 years. Bitcoin is simply too volatile to be a part or the basis of a real payment system. I mean, even Bitcoin jumps by 10% from one day to the next. It is simply not viable. As we all know, Bitcoin has become something more of an investment vehicle, although it was originally designed as a payment system. Pop culturally speaking, who's that? Huh? Okay, I'm a child of the 90s, Radiohead. Radiohead was acknowledged as one of the best bands of the 90s, what they did with their guitars, etc., etc. It was state of the art, it was modern. Critics loved them, the music industry loved them, music aficionados loved them, but you hardly hear them on the radio. Which is kind of similar with Bitcoin. Everybody agrees that it was, back then it was new, it was sensational, it has huge potential, but at the end of the day, it will probably be not used on a global scale. Then we have the first new contender, and we all know that as well, the digital euro or other official central bank digital currencies. Well, when I wrote this presentation, I said, well, nothing is really happening because there is a draft, and now it's getting a little legal. There is a draft by the European Commission out there about the digital euro. That was released about 2.5 years ago. And so far, nothing has really happened, and this whole draft, in my opinion, reads a little bit more like a policy paper because some absolute fundamentals of how a digital euro should be structured are simply not in there. Yeah, so for example, the role of the banks in the digital euro is not really outlined in detail, and in a lot of passages, which is impossible for a real draft for legislation. The draft says in a lot of places simply, yeah, the European Central Bank will figure that out. And since then, nothing has really happened until, I mean, you may have heard it about 2 weeks ago, 3 weeks ago, Ursula von der Leyen said, yeah, we are now all of a sudden moving forward with the digital euro, which was clearly triggered by the rise of the stable coins, in particular in the US. And now we're actually thinking about moving it to public blockchain. I thought, what? If you follow, I'm not against public blockchains, don't get me wrong, but if you had followed the whole discussion about the digital euro over the last 5 years, European policymakers and the European Central Bank did their very best not to use the term blockchain and digital euro in one sentence. They always discussed the digital euro as a concept. Will it be retail? Will it be wholesale? Etc., etc. But they never really talked about blockchain. They really wanted to keep blockchain out of the equation, at least officially. So that's a real change. Let's see what happens there. In talks like a few months ago, I said we will not have a digital euro before 2035. Now things might have sped up a little bit, who knows. But for me, the digital euro is like Prince Charles. So not like Camilla, but Prince Charles is always around. And he's waiting for the throne for 30 years. Next contender, stablecoins, and you all know what stablecoins are. We do not need to talk about that in details. But we know that stablecoins, although they are very, very promising in concept, they come with some weaknesses, and it's a little surprising that a lot of weaknesses are not really being told about. First one, stability. Well, when it comes to stablecoins, we have two different meanings of stability. We have the stability, for example, as an US dollar token or a euro token. How are they able to keep the token stable in relation to the underlying asset? But the big issue about stability, from my view, is more the systemic stability. Because at the end of the day, stablecoins are issued by private companies. Could be fintechs, could be banks, whatsoever. And I was actually quite amazed when the idiot in the White House, so Donald Trump, announced that stablecoins would be the way to stabilize the US dollar because we can draft the rules in a way that the reserve of assets could be US bonds, et cetera, and that would stabilize the dollar price, et cetera, et cetera. Sounds good, but if this happens, stablecoins will become a systemic payment. They will become systemic for the whole capital markets. And I am kind of a little concerned if a company like Tether is basically taking over the role of banks or central banks in terms of stability. First issue. Second issue, what happens with stablecoins these days? Everything is US dollar, we know that. The euro stablecoins are, I think, what is it? 0.1, 0.2% of the global cake. So we will have a certain kind of reliance on the US. Again, even, let's be honest about it, even if Mika becomes really, really popular and all the Mika euro stablecoins are successful, and at the end of the day will still be just a fraction, a small fraction of the whole market will be in euro stablecoins. So it is not all gold that glitters. And, big thing, the stablecoin market is developing. It's still not there. Yeah? Everybody announces things. We hear about Walmart who want to issue their own stablecoins. We hear about Tether. We hear about Circle. We hear about the banks who want to do something, but it's still not there. Yeah? So the market is still up for grabs. For me, stablecoins are, let's say, the Pokemons, and I have a 6-year-old son, so I'm a little familiar with these things. So that's who doesn't know this Pikachu. And the thing about stablecoins and also about Pokemon is, you hear little about them and all of a sudden they are all over the place and you do not in what stage or how they will develop. Yeah? Pokemons like Pikachu can become incredibly powerful in certain situations, so it's simplifying things. But this, all I've said so far, is things most of you guys probably already know. So, and here comes actually the topic I actually want to talk about. Because the incumbent banks, in this case, mostly German banks, they had an idea. They said, hang on, in contrast to stablecoins, which need to be built as a network infrastructure, because stablecoins are infrastructure, they need clients. Yeah? They need to grab their market share. We have a market share because we have millions and millions of clients. And these clients have billions in our bank accounts. So why don't we tokenize our clients' deposits? And that is the commercial bank money token. This is originally a study from Deutsche Kreditwirtschaft in 2023, which is based on mostly then German law. There is a parallel paper, same year, that focuses on basically European law. Yeah? Although, of course, at the end of the day, it's pretty much the same. So the idea is basically, we have the money, we have the clients, let's tokenize it. Not the clients, but the money. And this comes, also how would that work? Again, there are concepts out there, and the concepts can, of course, differ a little bit. But if a client basically agrees, I have my bank account, then I can either transfer my bank account or a part of my bank account onto the blockchain, so it's just stored on the blockchain. At the end of the day, it is simply a different way of storing the data. Because as we all know, having having money in the banks is also just an accounting unit in the bank's internal system. That's it. So nothing big changes there. Now, if the clients want to send money or pay through a card or whatsoever, a retailer, they transfer this token into the wallet of the recipient, private recipient or business, and they cash the token in with the other bank. There are different models now. In some cases, the token is just created and then burned just for this transaction. In alternative scenarios, the whole account is basically tokenized for longer duration. There are just different lines of thinking about it. But it's actually very, very simple. definitely much more simple than the banking system is right now. What is the big advantages? Well, we have real tokens, yeah? Smart contracts can be programmed, and we do not have, in particular, these different incompatible internal banking systems. Everything is happening under one protocol on one particular blockchain or compatible blockchains. Sounds, in principle, really easy. So what is the advantage now? First one, it is money. It is still money. It's not a tokenized, it's not a stable coin, it's not a Bitcoin, it is actually money. And although we might need to look a little closer at that, it remains money if it is tokenized. So, what's the first advantage? If we are a bank and issue this, we do not have a need for a reserve of assets. And as we all know, this is what makes stablecoins so expensive for the issuer. Why don't we need that? Well, we're subject to the banking regulation. We have capital requirements, it's all already there. Not because it's a stablecoin, but because we are a bank. If we say this is money, then this is covered by deposit insurance. Yeah, you know, for private, for private customers, I think it's up to 100,000 euro, is covered by European Union and national schemes. Which, of course, in the case of a failure of a stablecoin is a completely different story. Here it's covered by the state, which makes it, well, much more, it's a bad word, but much more stable. And the third one, if it's money and it's still a bank account, then we can pay interest. Paying interest on stablecoins under MiCA and also under the Genius Act in the US is a bit of a deal breaker. So just by changing the way this electronic money or this book money is stored, we can reap a lot of advantages from the old banking system and combine them with the transferability of blockchain-based tokens. Second advantage, although, well, you could also see it as a disadvantage, hey, we are banks, right? So we have the customers. I mean, one of the big problems for stablecoin issuers is they need to convince businesses, users, etc., to use their product. The banks already have the customers. Private customers, business customers, etc., Banks are generally seen, stay with me, as trustworthy and reliable. I'm not saying that the blockchain community sees them as reliable, etc., I do not say that they're sympathetic or whatsoever, but the general perception in the market by businesses, by traders, etc., they know what banks are, they know what banks do. And banks, by doing this, would be able not to be put into the bracket of, oh, crypto is evil, crypto is something I do not understand. They would be in the bracket of banks. Whether that's good or bad, up for the customer, but I think it's an advantage. And as I already said, we are already subject to capital requirements, own capital, etc. We are already subject to governance arrangements and certain internal controls, etc. So the regulatory structure is all there. The banks know what they are doing. Very often they don't know exactly what they're doing in terms of crypto, but they know what they're doing in terms of capital and internal governance. Sounds good. Problem. This, of course, only works within a bank, or it works if enough banks participate in the system. Why is that? Well, if I send a token to you, you can only cash it in with your bank if the bank is in the system. If they do not participate, we have a problem. So this would only work if either all the banks or at least a huge percentage of banks would actually participate. Think of it from a consumer perspective. You have your card. Yeah? You don't understand how it works anyway, but you are being told then, oh no, you can't pay because you're Deutsche Bank and this is Sparkasse. It doesn't work together. This is something that customers would hate. Yeah? And that's probably a deal breaker. So we would need, or they would need, a significant number of members. And this is where it gets complicated. As soon as you have 10, 15, 50, 200 banks in this system, you need to make sure that everything is compatible. If you really want a payment system, then it should also not just be for the euro, but for other currencies as well. So you need to factor that in too. Yeah? That it must be possible basically to translate these things from one currency into the next. Would you rely on one blockchain? Do banks have their systems with different blockchains? Are they compatible? How do we factor that in? And something that's very often neglected, anti-money laundering. Because if you want to be part of that system, we need to undergo a KYC process. However, KYC process or the AML regulations is not just about basically identifying, et cetera, it's also about reporting of transactions, et cetera. In this system, this would need to be done by other banks for customers of other banks. And this is where it gets really, really tricky, because what happens if bank 1 fucks up the KYC? Is then bank B liable in that case? So it is really, really tricky. And this is apparently where things are stuck right now. As I said, I'm talking about a concept. I'm not an insider in what is currently happening, how far they are. Just what I've heard is that on the one hand, the KYC procedure is tricky, and second, it seems to be more complicated in practice than they actually think. And since this is the regulation track, we have a second problem. And that's a legal one. We have a huge legal uncertainty here. And this is, okay, it's not a problem, let's call it a challenge. I'm with TUM School of Management. We never have problems, we always face challenges. What's the challenge here? It is not, remember I said earlier, it is still money. We have a bank account, we tokenize it, it is still money. And I said we'll need to get back to that a little later, because it's not 100% clear. European law, or German law, does not regulate tokenized deposits. It is acknowledged or recognized in 1 or 2 European legislative acts, for example, the DLT pilot, that there can be tokenized money. It's mentioned there, but it's not regulated, which means here comes the legal game that lawyers have been playing for 6 or 7 years now in the crypto space. Ooh, we have a new product. How does it fit into the existing categories? This is what we've done with ICOs, et cetera, We know that game. And here the question is, if we tokenize bank deposits, are they really still money? First argument on the left says, from the banking side, hang on. We have, right now, databases. We have our system, and your money is in our system. If you have 500 euro in the system or on your account, it's set out in our system. It's just data. And it cannot make a difference whether this data is stored on our service or on a blockchain, because blockchain is a database, full stop. It doesn't change, the data is the same. Therefore, the argument goes, if we tokenize money, or tokenize deposits to be more precise, it is still money. So the bank account, or let's say the token that we have, is then the equivalent of a payment instrument. So like in the classical world, we have the bank account and I transfer money to you. Direct transfer, wire transfer. Here it's the same, we have the bank account and the token is nothing but the direct money transfer. Is that a good argument? I think it's a very good argument. But, and here we see one of these basic problems about blockchain, because it doesn't really fit into the existing categories, or let's say it fits into different categories, because you could also say, yeah, hang on, as soon as we have a token and we transfer that token, it represents money. Because it is, as we said, it was money in the bank account, so we transfer it now. And this sounds for us a lot like e-money. E-money is separately regulated. And in simple terms, e-money overrides other regulation, for example, in MiCA, et cetera, et cetera. And why I like this argument or this challenge, it reflects the double nature of blockchain. On the one hand, it's a database. On the other hand, it's something transferable or makes data transferable. Data transferable, but you know what I mean. If we follow argument 2, then we would say it's not a deposit anymore. Therefore, it's not a payment instrument. We do not have deposit insurance. You would need to back up these tokens with much more separate money. So not just what's in the bank account and then you have your capital requirements as a bank. You would need to put much more money into it comparable to stablecoins. And deposit insurance would not apply either. And that would not kill the business case, but it just would take away what is so, let's say, so elegant about it. Is there a right or a wrong? No, it isn't, because, as I said, it's not clarified yet. So far, as I think all academics who have written about it are in camp 1, including me, because I think it's just more convincing at the end of the day, and I do not see serious issues for the customers, because at the end the bank is still regulated with their capital requirements, but it's not clear. And of course, it would be an absolute mess if the German banks, so the German banks being the spearhead of this whole thing, the German banks create this system, invest the money, and then, for example, BaFin comes and says, actually, we think it's e-money and not a bank account anymore. That would be basically the worst case scenario. So we simply do not know. So what needs to happen now? From a legal perspective, and as I said, I'm not insider when it comes to the technical issues, but I understand the legal issues behind it. Some clarification would be nice on the European level or whatsoever. So, who will it be? Yeah? Will it be the banks who basically transfer their market power and their dominance over the payment system through this new idea into the digital economy? It's possible, because that's the consequence. So the banks would leverage their market positions now into the new system. And there are people who do not like that. Of course, stablecoin issuers, et cetera, do not like that. Plus, there are actually a lot of businesses out there who would prefer a payment system without the banks, because they hope it would be cheaper. Will we know, or when will we know? I have no idea. It's still under discussion. The problem is, if it takes too long, then it will probably not come to fruition, because the cake is being divided right now. I think this is an extremely interesting concept, and again, I'm only talking about concepts, that might be, if it's done well, that has the potential to be a real contender for stablecoins. If it will it become? I don't know. Yeah, let's meet again in 1 year, and maybe I give a follow-up speech about that in 1 year. No idea. Thanks a lot. Do we take questions? What's the procedure? So, if there are 1 or 2 questions or something, because if that's not the case, then I always say thank you, and we probably then see each other again in 1 year, right?
And of course, for the 30-year stand-in,